Here's a summary of American Airlines Group's third quarter 2025 earnings conference call, designed for clear and concise delivery. Introduction. Thank you for joining us today for American Airlines Group's third quarter 2025 earnings conference call. On the call with us are CEO Robert Isom and CFO Devon May. CEO's opening remarks. Robert Isom. Good morning. This quarter, American reported an adjusted pretax loss of $139 million, or 17 cents per share. This result was at the higher end of our guidance, driven by stronger revenue performance, and we've adjusted our fourth quarter and full-year outlook accordingly. I'm proud of our team's execution despite challenging operating conditions. We're focused on long-term success, and there's significant revenue opportunity ahead, with considerable upside expected in 2026. Our revenue momentum is a product of sales and revenue management initiatives, the scaling of our new agreement with Citi, restoring capacity in our hubs, and consistent improvements in customer experience. Today, we're also pleased to name Nat Piper as our new Chief Commercial Officer, effective November 3rd. Steve Johnson will transition back to his role as Vice Chair and Chief Strategy Officer. Regarding our commercial efforts, sales, and distribution, we're aggressively using our loyalty program to win back customers, with corporate revenue growing 14% year-over-year. We expect to fully recover our lost revenue share by year-end and focus on exceeding historical levels. Citi Partnership. Our exclusive partnership with Citi begins January 1st. We've successfully transitioned in-flight acquisition channels and launched a new co-brand card. By the end of the decade, we anticipate annual remuneration from partners reaching approximately $10 billion, with an incremental annual benefit to operating income of about $1.5 billion compared to 2024. Loyalty Program. Active AAdvantage accounts grew 7% year-over-year, with strong growth in Chicago. AAdvantage members are more engaged, generate higher yields, and are key to premium cabin demand. Hub Network. We're scaling our hubs, focusing growth this year on Chicago, Philadelphia, and New York, with improved schedules and product offerings winning local customers. This targeted expansion continues into 2026. Fleet and Product. We're increasing premium seats at nearly twice the rate of main cabin seats and expect over a 50% growth in lie-flat seats by the end of the decade, supported by new aircraft deliveries and fleet reconfigurations. Customer Experience. Investments in airport infrastructure, like the new Terminal F at DFW and our new flagship suite, are elevating the travel experience. We're also rolling out high-speed satellite Wi-Fi across more aircraft than any other airline, which will be complimentary for AAdvantage members starting in January. New flagship lounges in Miami and Charlotte, along with enhanced Admirals clubs, amenity kits, and food and beverage offerings, are also part of our focus. Reliability. Despite challenging conditions, the American team maintained a resilient operation, minimizing disruptions through investments in technology like the Connect Assist platform. Finally, I want to acknowledge the dedication of aviation professionals during the government shutdown. CFO's Financial Review and Outlook. Devon May. Thank you, Robert. Excluding special items, we reported an adjusted loss per share of 17 cents, a 50% beat against our prior guidance. We achieved record third-quarter revenue of $13.7 billion, about 1% ahead of our initial guidance. Domestic PRASM improved sequentially each month, turning positive in September, and this momentum has continued into October. Revenue performance. Premium cabins continue to outperform the main cabin, though we've seen improvement in the main cabin since its low in July. International entities performed in line with guidance. The Atlantic region was our most profitable, and we expect solid positive unit revenue in the fourth quarter. Latin America saw headwinds from oversupply in the short-haul market, but our strong presence allows for profitable results. Pacific unit revenue declined mid-single digits, and we expect fourth quarter unit revenues to be approximately flat year-over-year. Premium travel. Premium unit revenue outpaced the main cabin by 5 percentage points. We're expanding our premium offerings, including the new flagship suite on our 787-9s, with plans to introduce it on A321XLRs and retrofit 2,777-300 aircraft. We're also expanding premium seating on domestic aircraft, increasing first-class seating on A319s and A320s by 50% and 33%, respectively. Capital expenditures. Total capital expenditures for 2025 are expected to be approximately $3.8 billion, including 51 new aircraft. Our 2026 expectations are $4 billion to $4.5 billion. Balance sheet. Total debt was $36.8 billion at quarter end, down $1.2 billion. We ended with $10.3 billion in available liquidity. We are more than 50% of the way towards our commitment to reduce total debt by approximately $4 billion to less than $35 billion by the end of 2027. Fourth quarter outlook. We expect capacity to be up 3% to 5% year-over-year. Revenue is projected to be up 3% to 5% year-over-year. CSMX is anticipated to be up 2.5% to 4.5% year-over-year. We are projecting an adjusted operating margin between 5% and 7% and earnings per share between 45 cents and 75 cents. Full year outlook. This brings our full-year EPS guidance to a range of 65 cents to 95 cents per share. We expect to generate free cash flow of over $1 billion for the year. We are committed to re-engineering the business through technology and process improvements, driving annual savings of $750 million versus 2023. With labor cost certainty through 2027, we're well-positioned to execute on our commercial and customer initiatives. Key financial metrics summary. Revenue. Q3 2025 $13.7 billion. Record for Q3, about 1% ahead of initial guidance. Profit. Q3 2025 adjusted pretax loss of $139 million, or 17 cents per share. Gross margin. Not explicitly stated as a single percentage, but revenue performance and cost efficiency efforts are highlighted as drivers. Future forecasts. Q4 2025. Capacity up 3 to 5%, revenue up 3 to 5%, CSMX up 2.5 to 4.5%, adjusted operating margin 5 to 7%, EPS 45 to 75 cents. Full year 2025. EPS guidance 65 to 95 cents. Free cash flow over $1 billion. 2026. Capital expenditures projected at $4 billion to $4.5 billion. Longer term. Remuneration from partners to reach $10 billion annually by decade end, with an incremental operating income benefit of $1.5 billion. Versus 2024. Premium seat growth expected at 2x main cabin. Lie-flat seats up over 50% by decade end. Debt target below $35 billion by end of 2027. Significant risk factors. While not extensively detailed in the call, the transcript implicitly points to macroeconomic uncertainty, mentioned as impacting booking windows and price-sensitive customers. Competition. Discussed in the context of Chicago market share and labor cost advantages. Operational challenges. Acknowledged for the third quarter, though the team recovered well. Fleet delivery delays. Briefly mentioned as a reason for not serving markets as thoroughly as desired. Highlights. Strong revenue performance, exceeding initial guidance in Q3 and showing positive sequential trends. Positive September unit revenue. A key improvement noted. Successful hub restoration, particularly in Chicago, Philadelphia, and New York. Significant growth in loyalty program. 7% increase in active accounts, with a notable 20% jump in Chicago. Strategic city partnership. Expected to drive substantial long-term revenue and profit. Premium product investment. Doubling premium seat growth rate and significant expansion of lie-flat seats. Customer experience enhancements. New lounges, amenity kits, Wi-Fi improvements, and facility investments. Balance sheet strengthening. Ahead of debt reduction targets. Capital efficiency. Achieving capacity growth with disciplined CapEx. Lowlights third quarter loss. An adjusted pre-tax loss of $139 million. International unit revenue pressure. Specific challenges noted in Latin America and the Pacific. Industry-wide challenges. Mention of a challenging July for the industry. Most important statements, CEO Robert Isom. We recognize there's significant revenue opportunity ahead of us, and we're excited about the good work underway to accelerate our revenue growth and view that as considerable upside as we move into 2026. American has a long history in all three cities, Chicago, Philadelphia, New York, with a base of corporate and premium customers that are loyal to the American brand. Our improved schedules, along with our new sales and distribution strategy and other product improvements, are helping us win local high-value customers. Nothing matters more to our customers than flying on a reliable airline. While this quarter presented challenging operating conditions, the American team quickly recovered, minimized disruptions, and maintained a resilient operation for our customers. CFO Devon May. We produced record third quarter revenue of $13.7 billion, which was about 1% ahead of the midpoint of our initial guidance. We continue to make progress in strengthening the balance sheet. Total debt at the end of the third quarter was $36.8 billion, down by $1.2 billion from the second quarter. Just 9 months after making that commitment, we are more than 50% of the way to achieving the goal. With this fourth quarter guidance, we expect to deliver an adjusted operating margin of between 5% and 7% and earnings per share between 45 cents and 75 cents, over 2x higher than the midpoint of our implied fourth quarter guidance from July. Concluding remarks. We're positioning American for long-term success. We're looking forward to closing out 2025 in strong fashion, and with this groundwork, we plan to deliver meaningful long-term value for our shareholders in 2026 and beyond. Thank you for your interest in American Airlines.